Welcome to Talk Tickers. Today, we're breaking down the Q3 2025 earnings call for Lisata Therapeutics, ticker LSTA. And this is one of those reports that kind of makes you scratch your head. On the surface, the company beat expectations. Sounds good, right? Well, the stock immediately plummeted. So what's really going on here? The numbers are telling one story, but the market is screaming a completely different one. Okay, so here's how we're going to unpack this whole puzzle. First, we'll look at those paradoxical results, the earnings beat and that massive drop. Then, we'll dive into management's very bullish story, which is all about the science. After that, we're going to dissect the market's verdict and why it was so different. And of course, we'll wrap it all up with our outlook and rating in a segment we call The Next Call. All right, first up, let's get right into the numbers from their November 6th call. This is where the whole conflict begins, and honestly, it's a real head-scratcher for anyone watching this stock. On the one hand, things looked great. Lisatas' earnings per share came in at a loss of 49 cents. Now, that might not sound amazing, but Wall Street was expecting a 54-cent loss, so that's a solid beat. But then, you look at the market's reaction. The stock just tanked, down over 12%. A beat on earnings followed by a double-digit sell-off. That's the paradox we're here to solve. And if you look a little closer at the numbers, the story actually gets even better from Lisata's perspective. Their net loss actually narrowed from $4.9 million last year down to $4.2 million. And they did this by cutting operating expenses by a whopping 17.3%. So they're managing to advance their clinical trials while actually spending less money. So again, that just brings us back to that nagging question, why the sell-off? So, with a financial beat and tighter spending, what was management's narrative on the call? Well, simply put, they wanted investors to focus on the science, on the pipeline, not on the stock price. Let's see how they built that case. The CEO, David Mazzazzo, basically said they're heading into a data and transaction-rich period. The message was crystal clear. Hey, don't get bogged down in the quarterly numbers. Look at the huge pipeline of clinical data we have coming. They were really trying to paint a picture of a company right on the cusp of a major breakthrough. And they didn't just talk, they backed it up with some real progress. Their BOLSTER trial, enrolling 6 months ahead of schedule. The ASCEND trial, showing stronger and stronger signs that it's working. And their CENDIFOX trial, promising results there too. From management's point of view, it's just a steady drumbeat of good news coming out of the lab. They also really hammered home their financial discipline. They've got a cash runway that they say will last into the first quarter of 2027, and they stress their focus on what they call non-dilutive financing. All that really means is they're trying to get money through partnerships, like these new deals with Catalent and GATC Health, instead of selling more stock and watering down the value for everyone who already owns it. Okay, so the science is moving forward, the finances look tight. Why the massive sell-off? This brings us to the other side of the story, the market's verdict, because investors were clearly looking at a completely different picture. So this is the crucial point, right? Understanding this gap between management's optimism and the market's skepticism. And really, it all comes down to some pretty simple and, frankly, pretty brutal math. The company has $19 million in cash and cash equivalents. Now, for a small biotech, that might seem like a decent chunk of change, but that number doesn't tell the whole story. Because they're burning through over $4 million every single quarter. So when investors heard management talk about a cash runway into 2027, they did the math. And they realized that runway doesn't account for the enormous, and I mean enormous, cost of a pivotal phase 3 trial. The market is basically looking past all the current good news because it sees a massive funding cliff just over the horizon. And this chart really puts that investor frustration into context. While the broader biotech sector, we're using the XBI ETF as a proxy here, is up a healthy 24% over the last year, Lisata is down 27%. Ouch. This isn't just one bad day. It's a sign of deep long-term skepticism from investors who are pretty sure the company is eventually going to have to sell a lot more stock to survive. So, what does this all mean for the future? Well, that brings us to our final segment, The Next Call, where we lay out our thesis, our prediction, and our rating. Look, the entire near-term story for this stock really boils down to this catalyst map right here. The next huge moment, the one everyone is waiting for, is the top-line data from their BOLSTER trial. That's expected in the fourth quarter. This is the data that could finally, maybe, change the entire narrative for the company. So, when you weigh everything, the promising science and the disciplined spending on one side, against that massive financing overhang and the deeply negative market sentiment on the other, we are initiating our coverage of Lisata with a market perform rating. So here's our thinking in a nutshell. Lista is stuck in a classic biotech standoff. On one side, you have the science behind their main drug, certepetide, which looks more and more promising. But on the other side, you have a completely uncertain path to funding a huge, expensive late-stage trial. We think this financing question is going to keep the stock stuck in a range until one of two things happens. Either they release some truly game-changing data, or they announce a major partnership that solves the money problem once and for all. So we'll leave you with this final thought. The science looks good, but the stock is suffering. The whole story now really comes down to one big question. Will that upcoming BOLSTER data be good enough to finally break the cycle of positive results and negative returns and maybe attract a partner with some really deep pockets? That's the billion-dollar question. This is not financial advice.